Let's start by delving into the crisis in the Red Sea. The alarming escalation of assaults on commercial vessels has been in response to Israel's actions in Gaza by Iran-backed rebels, the Houthi. Since late November, the conflict zone, the Bab-el-Mandeb Strait, has been a hotspot. This escalating hostility and risk have compelled shipping industry leaders to rethink their course. Prioritizing safety, established shipping giants such as Maersk and Hapag-Lloyd have decided to suspend their shipments through the turbulent Red Sea. Wondering about the Red Sea? This body of water is a significant trade route. The Suez Canal, its link to the Mediterranean, manages a significant chunk of worldwide commerce. This amounts to roughly 12% of all global trade. An impressive half of the cargo traversing Suez Canal comprises containerized goods. This statistic underscores its immense importance. It stands as a vital trade route from Asia to Europe, demonstrating its global significance. So why the Red Sea indeed? It's pivotal for global trade from Asia to Europe. Now imagine the impact of rerouting. Ships, traditionally following a set path, have had to drastically change their course, rerouting around the enormous Cape of Good Hope. This rerouting adds a staggering 3,000 to 3,500 nautical miles to their journeys. The addition is not trivial, it dramatically extends the duration of their shipping times. But it doesn't end there. It also drastically inflates shipping and fuel costs due to the extra distance. And as the cherry on top of this logistical nightmare, it even drives up insurance costs. Think about the possible inflationary outcomes. The upsurge in shipping disruptions can contribute to an unexpected rise in costs. When ships are rerouted, it escalates both fuel and insurance expenses significantly. Further, global oil prices have gone up due to heightened worries about potential delays in the Red Sea and disturbances in Libya's largest oil field. However, in the midst of all this chaos, crude prices have managed to maintain relative steadiness. Let's look back at history. The Suez Canal blockage in 2021 greatly from our present economic scenario. Throughout the pandemic, we've seen disruptions in global supply chains. However, our present circumstances arise in a climate of reducing inflation. The blockage in the Red Sea has resulted in a spike in freight costs, but these are still lower than at peak of pandemic-related upheaval. Now let's consider the effect of these differences on our current situation. Amid this situation, freight costs are still lower than during the pandemic disruptions. Think about the potential impact on turnaround times. The possibility of longer shipping times, be it a result of unfavorable weather, political unrest, or mechanical failures, could have a rippling effect on the flow of global commerce. This could significantly alter turnaround times at the bustling, heart of trade, major ports. The ports like those in the United Kingdom stand as sentinels of trade, handling millions of cargo annually. This also applies to the pivotal European hubs, which are known for their substantial contribution to global trade. These hubs include the likes of the industrious Rotterdam port, the bustling port of Antwerp, and the historic port of Hamburg. What about the economic outlook? The globe is witnessing an unprecedented slowdown in commerce and growth. Fear of potential recessions looms over major economies like the US, UK, and EU. With trade volumes dwindling, these countries are stepping on thin ice. There's anxiety over inflation, but if the disruption proves to be brief, the overall impact might be contained. The impact could be restricted if this downturn doesn't last long. Lastly, consider the relationship between freight costs and inflation. Shipping costs, often underestimated, are a pivotal factor contributing to inflation. The COVID-19 pandemic, a disruption like none before, resulted in shipping costs adding a noteworthy 1 percentage point to the global inflation rate. Usual times see freight costs accounting for 7 of long-haul imports expenses, but disruptions can cause a significant spike. Even during normal times, freight costs account for about 7% of the costs of long-haul imports, but this can increase during disruptions. In conclusion, the Red Sea crisis poses challenges to global trade with potential implications for shipping costs, delays, and inflation. This situation brings into focus the dependence of global commerce on this region. Various factors like a slowdown in global growth and trading activities could potentially mitigate some of these impacts. This unfolding event serves as a reminder of how crucial geopolitical stability is. After all, it is key to preserving the continuous and seamless flow of international trade.